very much. Thank you all for being here and giving me the opportunity to speak in front of you. Now, I do realize that I'm the only thing standing between you and lunch. So I'll try to make it as interesting as I can. And for that, I thought that maybe I could start by taking you in a trip, not with a time machine, because we've used that quite a lot since last night, but maybe in a spaceship. And why do I want to do that? Is because I want to take you all up to hopefully help you see the big picture and go away from the benchmark and all these. That are very interesting questions, but I think that maybe some of the reasons that you are here is because you are certainly looking for new things, for new answers, and I do hope that we have some of them. Now, I don't want to lose the precious time that I have to tell you about the company. The only thing that I want to say is that by training I'm an actuary, so if it gets too technical, please do tell me something. And the other thing is that the company that I created in 2010 with Olivier, that is right there, is all about doing research on asset allocation, but not only doing research, also taking it a step further and bring it all the way to the institutional investors and hopefully to the pension funds. Now, some of the ideas that I'll talk about are not mainstream. And sometimes going against the flow is a bit uncomfortable. So I thought it would be nice to start up with a short video of someone that has been a figure in finance for many years, and that he has been looked up quite a lot, and that basically says something very powerful, which is, I've got it all wrong. So let's start with that, if you allow me.
The former chair of the Federal Reserve and one of the best-known names in finance returned to Capitol Hill today for the first time since the financial crisis began.
We are in the midst of a once-in-a-century credit tsunami. Central banks and governments are being required to take unprecedented measures.
My question for you is simple. Were you wrong?
Partially.
Democrats on the committee, led by the chairman, Henry Waxman of California, pressed Greenspan on whether his fundamental economic philosophy was mistaken.
The question I have for you is, you had an ideology, you had a belief. You feel that your ideology pushed you to make decisions that you wish you had not made.
Well, remember that what an ideology is a conceptual framework with the way people deal with reality. Everyone has one. You have to exist, you need an ideology. The question is whether it is accurate or not. And what I'm saying to you is, yes, I found a flaw. I don't know how significant or permanent it is, but I've been very distressed by that fact.
You found a flaw in the reality? A
flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
In other words, you found that your view of the world, your ideology was not right. It was not working.
Precisely. No, that's precisely the reason I was shocked, because I had been going for 40 years or more with very considerable evidence that it was working exceptionally well.
Okay, so we certainly do realize that this is a bit taken out of its context. But the idea was just to say, okay, things are not right. The pension fund industry as a whole is in a difficult situation. And just keeping doing it the old-fashioned way is not going to take us in any other better position. So what is that went wrong in the pension industry? Let's forget about 2008, because so many things have been said about that. But let's talk about really the goals of the pension funds and how their asset allocation is constructed, because we are at the level again of asset allocation, really making sure that liabilities and assets are somehow managed together in order to achieve something really like the holy grail of fully funded or something like that. I think that one of the first problem was the peers benchmarking, was everybody looking at everybody else and trying to do the same thing. But when we are talking about assets and liabilities, well, this is a very personal thing, and there shouldn't be any, like, you couldn't have the same solution in two even very close pension funds. So this is a world and a moment of doing things differently and really adapting the policy of every single pension fund to its own situation and not to what everybody else is doing. The other big problem, and that struck me basically last week, I was talking to some financial directors and trustees in the UK, and they talked about performance. And one of them was very distressed because he said, at the end of last year, I was very proud with my fund manager. He announced 11% performance. And I was just patting him on the back, saying, great. When my actuary said, well, wait, the funding ratio went down by 5%. And he was really distressed because he was like, I don't understand. How can I make such a great performance and have my asset liability ratio going down? And I think that has been a problem as well, targeting absolute returns instead of targeting something like liabilities. Other things that did go wrong were this like wholly reliance on hypotheses, on long-term hypotheses. First of all, it's really tough to get them right, and history has proved us again and again that we cannot get forecasting right. And the other problem is that long-term static asset allocation, well, it just supposes that the world isn't moving and requires lots of wishful thinking and lots of eyes closing in between and lots of praying that it works. Well, fortunately, regulation has started to jump in and say, wait, you cannot just say you're a long-term investor and you don't care about what's happening now in your funding ratio. You do need to take that into account. But then all of a sudden, all those long-term investors, they are not long-term investors anymore because they have very short-term constraints. And if they don't take them into account, then it's really bad. So all these things, basically, they've changed the landscape where we live in, and but this is okay because there are tools that can help the situation improve. Those tools come from academia, and they are there, and they're just there for you to use them. And what I'm going to try to show you today is a few of those tools. We don't sell. I don't have a product to sell you. I'm sorry. So it's just about ideas and things. Okay. Now. This approach that by now you know that this is a dynamic approach that we implement, and the name of the company is quite funny. We chose it before France lost its AAA, but active asset allocation is about being active about the risk that one takes all the time, and it's about finding solutions that will bring together, hopefully, the needs and wishes of financial directors in one hand and trustees on the other hand. And this is a tricky situation, especially for financial directors. They used to look at the situation of the pension plan for 5 minutes of the end of every year, and because it didn't matter to the bottom line. Today, for some companies, their pension fund has become like the biggest subsidiary. So these are really things that cannot be taken as easily anymore. So what are the aims of what can be put into place? Make sure that funding, full funding is achieved as quickly as possible, and that requires as little contributions or as little benefits reduction as possible. And also, as the situation improves, while protecting a higher and higher funding ratio for the benefits of everyone. Now, let me tell a few words about what I call the alternatives, but which are really what everybody does right now. Not everybody, but sorry for... And I'm not by any means talking about any of you in the room. But the most common approaches that are being used in the pension fund industry are, first of all, what we call the traditional LDI, which is hedging. And here the idea is to take the financial risk away by hedging the liabilities. But the problem with that is that if there's a funding gap, that funding gap will only be filled by contributions. And the other problem is that hedging the financial risk might not be enough, because with liabilities lay a lot of other risks, such as mortality or wage increase or inflation, depending on how the pension fund is structured. So this might not be a good enough solution for many pension funds. Now, there's, of course, the long-term strategic asset allocation, which, again, relies a lot on past return, risk characteristics and correlations, and also on forecasts about returns. And the problem is that as soon as we don't get those right, well, everything falls apart. And the other problem is that, again, this is not consistent with short-term constraints. One new idea that has been around for a few years now, very in vogue in the UK, for instance, is what we call de-risking, which is starting out with a static long-term allocation, and as the funding ratio improves, well, getting risk off the table and switching from the risky assets to the more liability hedging assets. Well, this is a strategy, I mean, and when we are talking about a stochastic environment, when you test everything that could happen, this is a strategy that in terms of returns, so in terms of contributions that are needed, is as bad as hedging, and in terms of risks, is as bad as static allocation. Because you can only start taking risk off the table if the situation does improve. So it's like when you choose that, make sure that you choose it at a moment where the risk assets will do well for a few years. All those things that are done, again, they can be potentially very costly and lead to potentially infinite contributions or infinite reduction in the benefits. So clearly they're not completely okay. Now the dynamic asset liability management, that approach, first of all, requires that you understand liabilities and that you understand funding ratio. And then the approach is really simple. The whole idea is about dividing the portfolio in two parts. One that will hedge the liabilities, partially, the liability hedging portfolio, and then a part that is there to bring in performance whenever that's possible. And then you will need to dynamically allocate between those two parts based on what? Based on risk parameters. And in a pension fund context, what could that be? Well, if you are in the defined benefits context, then it's a funding ratio, some sort of funding ratio, and you construct that risk parameter so that it goes up and up, the protection. And in a defined contributions, it's more like hedging for, first of all, preserving capital, all the capital that has been put in, or inflation or things like that. And then the idea is that the investment that is put into the performance-seeking portfolio should not only depend on some risk aversion and market conditions, but also, and this is a very important thing, on the margin for error that a pension fund has. If the margin for error goes down, the allocation to the PSP should go down as well, and that portfolio should be more and more hedged. This is the general idea. Then what I wanted to say is not only de-risking. This strategy is about both de- and re-risking. And this is also very important because in the short term, if your risk budget goes down, you should definitely de-risk. And then as the funding ratio improves, then in the short term you will re-risk. But that will improve the whole funding ratio, which will make you de-risk. So that's a bit. Just remember that you need to be able to both de- and re-risk this whole strategy. And most of all, it's an approach where everything is predefined. So whatever happens to the funding ratio, to where the fund stands, is predefined, and the board is able to validate the strategies as a whole. Now, for this to work, you might need basically, first of all, to make sure that the way that you design the rules is consistent to what you're trying to do. But then that you're using suitably constructed building blocks, meaning you want to have a liability hedging portfolio that does hedge the liabilities. And I'm not talking necessarily about doing very complex structures where you need all kind of swaps and overlays and all these kind of things. I'm just plain, it can be done with plain bonds, let's say. And also you need a PSP that has very specific characteristics. And in particular, you want the PSP to look more and more like a liability hedging portfolio when the growth assets don't perform well. Let me try to illustrate a bit how this works. It has been put forward by my colleagues, you cannot count on history to repeat itself. So you want to do something that works all the time. And how can you do that? You need to work in a stochastic environment where you are able to make as many scenarios as possible. And very important, you need to make scenarios that are going to be worse than what you've seen in the past. And that's very important because, again, we don't know what lays in front of us. The way we do that, we don't have time here to go into the methodology. But one thing that you don't want to use in here, it's Monte Carlo kind of approaches, because those approaches get rid of the extreme risks. And if you want to do risk management, that's a bit silly. Okay, so just to give you a picture, the way that you usually look at liabilities is this. Those are future streams of liabilities. Now, when you discount them using the yield curve, they're going to look more like this. Now, when we analyze them in a global world, they're going to look like this. This liabilities, where the yield curve has been stochastically stressed, and so any of these scenarios could happen. And I'm not talking about doing a macroeconomic analysis of that's far too complicated. It's really taking into account what could happen, changes in the shape, parallel swift, all these kind of things. And these kind of changes will do all funny things to the liabilities. Now, we do the same thing on the asset side. And for instance, here on the left, you see equities, everything that could happen to equities. And in particular, if this is 100, you see that in here you find scenarios that almost go to zero. So this is like Japan-like kind of scenarios for equities. But you also see here bond prices. And this is very important to have very stress bond prices because, again, if you just look at the history of European or US bonds, what we've seen is yields going down for the last like 15 years and bond prices going up. So in a way starting with just this, you can envisage different things. So you need to stress again the yield curve and get the bond prices from that, which allows you to have, in here you could imagine very easily scenarios where Greece goes out of the euro, but also Spain, or many things that are more or less stressed for the markets. Now, about constructing the best liability hedging portfolio, and going back to my example with that pension fund that I was telling you about in the UK, basically he said. Because I wanted to help him understand how that funding ratio of his could have deteriorated in such a way when the performance in his portfolio was so good. So what he told me was that he was using, to discount the liabilities, the 15 years rates. And that in his bond portfolio, he had something like the actuarial 6-year curve in the UK. So, and then I thought, okay, let's find a way of explaining it. So, if you just allow me to write down 2 formulas, okay? I promise it's not going to be too tough. Well, if you think about it, the way that liabilities are calculated, right? How you calculate the present value of your liabilities here, is that big enough? Yes? It's going to be the liabilities that you want to pay in year 1, discounted at the rate, the 1-year rate, plus the liabilities that you pay in year 2, the rate discounted at the rate year 2, plus let's say that the pension fund goes over 100 years. Well, the liabilities that you have to pay in year 100 divided by 1 plus R100. Now, the yield curve at some point gets flat, but so these are your liabilities. On the other side, you have your bonds. So how is the price of a bond calculated? Well, when you look at the price of a bond, in year Y, it's going to be the coupon that the bond pays in year 1, discounted to the rate of 1 year, plus coupon in year 2 to the 2-year, plus, let's imagine that we have something like a 6-year bond, then we have C6 plus 100, discounted 1 plus R6, 6. Okay. So if you have liabilities that are going to be over 1 year, over 100 years, and in front of them you put 6-year bonds, well, you see that if the yield curve moves, well, if it moves on the short side, the short side will move alike. But everything that happens after 6 years, you will not be able to reproduce it in your bond portfolio. So these two things will not move together, okay? Now, the problem of the pension fund that I was telling you about was that here, not only they were using just the short part of the curve, but instead of using R1, R2, R100, they were using R15. So see, there was no way to make those two things move together. So it doesn't matter that he did a great performance in the assets, because it can have a really reverse effect in the asset liability world. So this is just to illustrate, hopefully, how important it is to create at least in part of the portfolio, in the asset portfolio, something that will look like your liabilities. Was that clear? Okay, now if we look at the performance-seeking portfolio, I remember I was saying having equities in there is not enough, because at some point equities will go down and down and down and down, and if that happens, well, all the expected return above your benchmark, which is liabilities, will be negative, so this will hurt the funding ratio. So what you want is to construct a portfolio that, again, will be able to switch from, let's say, equities to something like bonds that cover your liabilities when everything goes wrong. And when you do that, when you put together, remember those graphs of equity and bonds, that two risky assets, when you put them together in a dynamic way, this is what you can achieve. You can achieve a distribution where there's nothing here. And this is how you want your performance portfolio to look like. And this is, again, very important. Now, I don't have much more time left. So what I do is show you just a quick case study. And then if you have other questions, you can always ask them over lunch. Okay, this is the way we build a dynamic ILM portfolio has different pieces. You have here equities, for instance. You also have bonds, and then you have your liability hedging portfolio. But all these things should move dynamically, depending on risk parameters. Again, there's no forecasting in this, in anything that I'm telling you about. Okay, so this is a big pension plan, a big US pension plan of a multinational company. And the idea was they have all the actuaries and consultants and fiduciary managers, so they've got the whole lot. And my job was just to look at anything they could do in terms of asset allocation to see if there was a better way than the other. Because they are in an underfunded situation, they're at 80% funding ratio, and they used to be at 100 in 2005. And ever since, they poured money into that pension fund. So here we are in the US, so there are some regulatory constraints where basically if you have a funding ratio that falls under 100, you have 7 years to put the money back. And there's also an internal constraint to that pension fund, which is if they ever fall under 80%, they top it up straight away at the end of the year. So those are the constraints we worked with. And the idea was to compare. Remember the three alternatives I was telling you about? You have the traditional LDI, which is invest everything, just to make everything comparable, in bonds that of the same duration. Then you have the fixed allocation given by the usual ILM study, which here is 50-50. The de-risking strategy, where you go from 50-50 to 100% in bonds as soon as funding ratio improves by 2%. And the last strategy, which is a strategy where you you're just trying to preserve a certain funding ratio. And this, by the way, has been determined with the financial director, because he said, I cannot put into the pension plan more than this amount, because otherwise the financial health of the whole company is put into jeopardy. And without further whatever, I want to show you the results. And again, we are not looking at a back test here, because again, if anything happens in the future that is different from the past, this wouldn't be relevant. So we look at the results in a stochastic world. Meaning we've done 1,000 scenarios for the yield curves, for all the assets in the portfolio, and apply those strategies. And okay, let me help you read this, because it's quite. So these are quantiles, meaning that here you have the worst 2.5 scenarios, so the worst 25 scenarios of our setting. These are the best scenarios. And here you have 75%, 25%, and 50% of them. Well, what you're looking here is at the funding ratio of this pension plan at the end of 10 years. And we compare the 4 strategies, which is the static allocation 50-50, the hedging, and the de-risking, and also the dynamic strategy. And what you can see here very easily with the color is that we have some kind of statistical dominance of the dynamic strategy, meaning that at the end of 10 years, the funding ratio that we find when applying a predefined dynamic allocation based on risk only is always better than everything else. And then the worst strategy in terms of funding ratio is obviously hedging. And why? Because all the money the improvement comes from the pocket of the company. And the idea is that after 10 years, after 7 years, so after 10, you're at 1. Okay, but these include contributions that were made. So now the really interesting question is, how many contributions were required to get there? And here are the contributions. So I've based everything to 100 here. So if you needed 100 in a static strategy in 50% of the scenarios, well, then you need a little bit more for if you do a hedging strategy. You need a little bit less if you do a de-risking strategy. And then you need significantly less contributions when you do a strategy where you protect funding ratio. And what's interesting to see is that here, in most scenarios, the contribution required by the dynamic strategy are going to be much less than the others. But obviously, when everything goes wrong, the best strategy is hedging. So it's good to find it here. You see that had we implemented a static strategy, the cost would have been double. From the difference from hedging to doing a static allocation that you'd rebalance, the cost would have been double. But if you look at the cost of the dynamic strategy, it would have been just slightly bigger. So that means that with the dynamic strategy, not only you get the upside, but you also get the downside protection, the hedging when that is needed, meaning all these bad things that could happen. Okay, so I think that, yeah, I'm there. Do I have more time or no? Okay, another minute. So another minute. This is, I put in here backtest, but it's just to show an illustration. What we do, when I went to see the board of the pension fund with this, not only have we done a backtest, because it's easy to compare, but we've looked at the best equity scenarios and the worst equity scenarios and the worst bond scenarios and compared all the strategies in all these cases to make sure that they understand the whole thing. So here's just to show you during this history that starts in 95 that basically the dynamic strategy ended up with a funding ratio much better than the others. And also that we've been able, this is the protection level, and we've been able to take it from 80% from, well, this is the starting point. So we were protecting something like 76%. And then we took it up to here more than 100%. So we've achieved funding, full funding. We are protecting a higher and higher level of funding. And this whole thing has been done with significantly less contributions that were needed in the dynamic strategy. So I hope I gave you some new ideas, some food for thought in terms of asset allocation and how you could think about it differently. And well, I'm happy to answer any questions if you have any. Thank you very much for your attention.